Good more earnings, everyone. How are we doing? I trust we are all doing well. The Nerdy Scientist here. So today I decided to do a short video to help you make better decisions as far as trading is concerned. As I insist, trading is a skill that everybody should have, and if you do it well, you're gonna make good money. Trading is not difficult. Trading is simple, yeah, but it's not easy. And the reason why most traders don't make money is because of lack of consistency and lack of a simple way for trading. So today I'm going to show you how I do my analysis and how I decide to make my decision on when to buy or when to sell and when to stay out of the market. Okay? Because if you do those three things correctly, and obviously the money management, you're gonna do very well in this industry. So today we're looking at the United States dollar against the South African rand, ZAR. Okay, as you can see from the monthly time frame, that's where I'm going to start. And then I will break it down. I'll do a top-down analysis. So before you start, I only use three indicators. Okay, the first indicator I use is the moving average, the EMA. Okay, so if you come here and you look at you just type EMA, yeah, I only use the two of those. So like now I'm using the triple EMA, but I have done modification to it. Once you add it, you'll see here, if I show you the EMA I'm using, okay, so I only use the 18 and 9. Okay, all the others I have deactivated them. You see, it's 18 and 9, and it's visible at all times. Okay, so you can see when you see the 18 is the blue one, and 9 is the red one. If the blue is above the red, you should be looking for sets. Okay, and if it's the other way around, if the red is above the blue, then you should be looking for buys. If they are together, yeah, as that means the market is raging. There are times like where you look at them and they are moving together, then you don't take any trades. Okay, that's when you wait for the direction to be clear. Okay, the next indicator I use, it's called William fractals. So if you go to the indicators here and you just write William fractal trailing stops, okay, if I click on that one, so if it doesn't appear on your list, you can just come and type William fractals. Okay, so I'm using the one done by this guy, Simple Crypto. Okay, so what I do is once I have the William fractals, I just I remove all the, I don't want all those other things. I only need to know which candle is at the peak. You know, where you have two candles on the opposite side. So where you see it's pointing green, that's telling you it's a good opportunity for you to consider buys. Excuse me. Okay, so let's start. So it's only two moving averages, 9 and 18, and then the William fractal to know where to expect the price to change direction. So what I do is, like when I come here, you can see there is a number of fractals in this area before this big move. Remember, we want to trade like the institutions. The institutions buy low and they sell high. So they put their big orders at certain areas. So when you're looking at the monthly time frame here, so what I can see is this is the most interesting part of the chart. So I'm gonna mark this. Okay, so I just come here, check this, and then I go all the way to the top to that candle. This is for my monthly, so I mark it monthly institutional level, and then I lock it in place. Then to make it even more useful, I'm going to use my Fibonacci retracement. Yes, that's the other indicator I use, and I'm going to put it right at the bottom there, and then to the top there. So, okay, in this case, it's telling us, okay, although the trade has been on a downtrend. The market moved from top there and it's now going down. Okay, so that means we are on a downtrend, so we should be looking for sales, but we're reaching an area within the monthly time frame whereby previously when the market reached this point it went up. So that's how you anticipate the change in direction. Okay, so what I do is I'll mark that region so that I remember that although we should be only be looking for sales only, we are approaching an area whereby the market might turn. So I'll mark that area. That's the preferred entry where I would want to take the trade if it reaches that level. So it's green. Green means buy. Remember that. Okay. And then I can remove the area from. I only want to sit on the monthly. So we have done that. Then we go to the weekly. When you go to the weekly, you can see here the most important candle as far as the William fractal is concerned. It's saying, the best time to consider taking a buy on the weekly time frame is if the price came to this level. Okay, so I'll draw here. You can see we have a triangle right at the bottom of that. So I just mark this. So it's saying if the price drops to this level, you can consider buys. Okay, so this would be like the ideal price where you are expecting the price to drop to. So I'll also mark it. Okay. However, as you can see here, when the price moved from this region and went up, it formed another bearish candle here and then it rocketed up. So that means there are also some orders expected to be here. But because there is no arrow saying that we should be considering a buy here, it's a less probable trade, but the market might respect the weekly chart. As you can see, although it has been dropping, when it came back and dropped into the monthly time frame here and started now an up trade, the last bearish candle on the weekly chart was this one. Okay, this is a full candle from here all the way to here. Okay, so that region probably still has some buy orders that were left by the big institutes. So that means this becomes less useful, but this is more probable a trade. And then the one we need to be paying attention to is this region. So I'll put my Fibonacci. Okay, as you can see, the price is dropping, and where I want to see the reaction is when it reaches the two double blue lines. If it reaches there in the next 2 days, then we can expect the US dollar to reverse against the rand, whereby the US dollar will be stronger and then we'll be looking to buy. But for now, you should be selling. Okay, as I'm recording this video. So I'm going to lock that into position. Another way you can look at this is you can see when the market was on a serious downtrend, then somehow the market got reversed. Okay, so you could as well monitor this from this point of view, but I want to keep it simple. You can say you can consider this candle and this region there. Okay, like that. But that's normally a less likely trade, because when you see a bullish candle that has been violated up, another candle came and closed above it, that tells you there's a change in momentum. Now we're on an uptrend, but I like focusing on the red candles. Remember what we say, you buy when there is fear in the market. So you buy in the red candles, you buy low, and you sell in the green candles, because that's how the big institutes do their trading. Okay, so once you have done that, once again, I am just going to mark the preferred entry here. I just use the rectangle mark my areas of interest. So it's that area. You see, I'm just focusing on the preferred entry. It's about 50%, and then it's a preferred entry, and then I mark it with pink. That's how I mark my monthly candle, my weekly candle, and then I lock it into position. I want this to be, I don't want too colorful chart, so I only want to see that, and these should be visible when I go to the daily. So you can see when you now go to the daily, it now has entered into the box for the weekly time frame. You can see here this region here, there was a lot of consolidation in this area. There is a lot of orders here, meaning that this is a very critical area, and probably when the market is dropping, as you can see, forming lower lows then higher lows, it's more likely to come somewhere around here before it can change direction. Okay, that's what the liquidity is, because there's a lot of people who bought here and they have put their stop losses there. Okay, so let's remove that. Okay, so that's where we're anticipating the price to come down. As you can see, before this drop started, yeah, you can see here, you can see we have our 9 moving average, which is above the 18, meaning that you should be looking for buys. And once again, just refresh your memory, whenever you see a red, a green candle, you know, you mark that card, you expect that the price will come back to it, you know, and when it comes back to it, you should be looking for buys. For example, if I was to look at if I was to look at this area here on the daily candle, you can see this red. If you had marked there and the price came back to it and you bought, that was your profit. When you did the same here and the price came back to it, that was your profit. How did we change the direction? You know, this is the highest point. You can see the area marked here by this red triangle at the top. So this was the last bearish candle responsible for the price to move all the way to about $15. Remember when we had riots in South Africa and the South African rand was getting weaker and weaker. So when it was getting weaker, it was nice to buy the dollar. You know, you sell the rand, you sell the weak currency, and you buy the stronger one. Okay, so I like marking that area, and I want this to be visible at all time frames, you know. And then under the text, okay, this happened on the daily chart, and we can say there was a break in the market structure. We were on a bullish trade whereby the 9 moving average, exponential moving average, was above the 18, meaning that we are supposed to be looking for buys at the time. Okay, so but somehow, although we expected when the price came down to carry on with the uptrend, as you can see, that got violated, and instead the price dropped into our box, give us a fake green candle, but dropped further. That's why we're saying on the daily time frame we have a break of market structure, and now we should be looking for sales. So I would mark this area, and now you see how I'm drawing my Fibonacci. It's from top to the bottom, okay, because we're looking for sales. Okay, as you can see, when this region got violated, yeah, the price went up, came down, but this candle here, I want to emphasize on this candle here, this red candle, yeah, closed below our two double lines, meaning that the bullish momentum was violated and now the market has shifted to a downtrend. Okay, when you see that, you should immediately now change your bias and you're expecting to form to go on the downtrend. If you sold at that point, by now you have made really good money. Okay, so I lock it into place. Okay, and I only want this to be visible on the daily, 1 hour and minutes. I don't want it on the weekly. Okay, once again, just to be sure about where I am, I always mark that. I add 2 additional lines. Okay, and then I can put it like that. So my daily, I mark it with a white color, and it's a red one because it's a bearish momentum, and I lock it, and I want that to be visible mainly from daily all the way down. I don't want it above. Okay, like that. And then I can afford to say I don't need to have the Fibonacci on these on minutes and hourly. Okay, so you can see now as you can see here, now there is a transition between, you hear people saying that the moving averages are, they lag, they are behind. You can see, although the change over of direction, if you're just looking at the naked candlestick, happened here on the 29th of July, it's only now that the moving averages are telling you, hey, you should start considering sales, you know, which is like 1, 2, 3, 4 days late. That's why we say moving averages are lagging. But if you want to take safe trades and you want to avoid over trading, you know, when you look at the daily time frame, if the red is above the blue, you know you should be looking for buys. But when you look at the chart here, you can see there is no way you could be buying unless you just randomly trading. So when you see that, then you know, okay, because there is confusion, the charts, the candles I'm seeing, I'm forming lower lows. I have seen break of market structure. I should be buying, but I don't see an opportunity to buy. If you are not sure, you stay out of the market. But if you like me and you can use other ways to tell the direction, then you could be in a sell trade and you're waiting to exit around this point. Okay, I hope it's making sense. Then if you go to 4 hours, the 4 hours would have given you more entries. Remember, when you're on a down trade, you want to sell high. Okay, so we saw the break of market structure happened quite late as far as the daily time frame was concerned. But if you go to the 4 hour, you can see this was the last bearish candle responsible for the highest point we can see here. Okay, so you mark that. That was responsible for this highest peak we saw there. So the moment any candle closed below this rectangle I have just drawn here, okay, let's mark it. So it's going to be red because it's a sale. Okay, for the 4 hour I use gray, and then I'm going to edit this and I'm going to say text. I have made shortcuts. I remove this and I say the 4 hour, we no longer on an up trade. Now we have started the bearish cycle. You see where daily chart only started selling around here. But somebody who was looking at the 4 hour time frame, they saw the break of market structure. You wait for the retest, this up trade, and then if you are really aggressive, this was your entry. You know, it came back again, retested the same area, but it's forming lower lows, telling you the direction is now you should be selling. Okay, you see, so that way I always say whenever you're doing your trading, you only want to pay attention to the 4 hour and the daily time frame. Okay, then you get your bias from that. So you can see here the red line is a 9 exponential moving average is above the blue, until when this candle, this big downshift candle was formed, that broke the market structure, and now the two moving averages are now together. You know, when you see a situation like this, it's raging. Obviously, if you know what I'm talking about by now, you should know, you wait for the retest and you can sell. But when you see both of them at the same level, that's a raging market. You don't want to be involved in that. But as you know, you see a break in market structure, wait for the retest, and then you're in for your money. Okay, so now you can see, all what you should be doing now is you wait to see the green candles. When you see the green candles, you know it's time for your entry. And if your entry is coming at the best timings, like the opening of the London session or New York session, then those are like the best entries you can have. Okay, so that would be my breakdown. So as you speak, and today you can see the next best entry was around here. You know, so if you are trading these, whenever you see a green candle, you know that should be a target for you to consider an entry if it gets retested. Okay, that doesn't happen all the time, but those are normally like the best trades you can have. You could see another opportunity there. If it gets retested, then you should take those sales. So you just, on a downtrend, you focus on the bullish candles. A bullish candle is a green candle whose the opening is lower than the closing. When you're looking at an uptrend, you focus on the bearish candles. Okay, you could refine your entries by going to 1 hour. You'll see in 1 hour you would have had more opportunities. Okay, and you also can see the price is respecting the moving average. You can see the price is remaining below the 20 and the below the 18 and the 9 moving average. You can see here the 18 moving average is above the 9, meaning that you should only be considering sales. Okay, but we're monitoring around this region to see what will happen when the price reaches this area. Okay, so for the entries, obviously you zoom in and you can go to a much lower time frame. Okay, I hope this helps you, avoid over trading and also getting the direction bias. If you do that and then you just do proper money management, then you're in to make good money. Okay, so I just used US dollar, South African rand to do that analysis. But as you can see, these are the pairs that I normally trade. I do trade gold, Canadian dollar versus the Japanese yen, Audi Australian dollar, and the chef, the Switzerland, and these are all my other pairs. For now, we're just monitoring to see where the market is going. We had big news relating the New Zealand dollar, and you can see the reaction. The New Zealand dollar is very strong, it's very bullish, so it's way stronger than the euro. And you can see the reason why, because in as much I'm a technical trader, I always combine my technical with my a bit of the fundamental. So if you go to the calendar, you can see today we had two pieces of news, about New Zealand dollar. Because it was early in the morning. There was an employment change and an unemployment change. With the employment change, you can see there is more people who have jobs. That is very good for the New Zealand dollar. That means it's bullish. And the unemployment went lower. There is fewer and fewer people who are jobless. That means that translates to a very strong New Zealand dollar. Okay, so that's my story, and I hope you learned something. So all you need to do is go to your indicators, add the moving average, the 9 and 18, then you can add William fractals, and then you're good to go. Okay, although in this case I only referred to trading forex, this approach works for both forex, cryptocurrency, assets, any commodity that's tradable. You can use this technique. It's not specific for any market. because all the markets are driven by the money maker or smart money or the institution. So apply it, then you're gonna be profitable. Thank you, and let's keep learning and